What's up, everybody? Welcome back to the Seven Figure Flipping Podcast. This is Bill Allen. I know I haven't done a show in a while, but I really wanted to get on with a friend of mine who is just blowing my mind with some of the tax stuff he's doing and some of the debt, cash flow, that kind of stuff. So for those of you that are interested in selling your business one day, or you have a bunch of money in Bitcoin, or you're going to sell a bunch of your real estate off, it could be rental properties, and you're thinking about maybe 1031ing, this is absolutely a show that you must listen to. This is a better version of the 1031 with a lot of options. And I absolutely love it. We talked about a lot of things. If you're financially savvy, you're going to love it. If you're not, you might have to listen to it a couple times. That's okay. But even if this isn't for you right now, it will be in the future. So I loved this show. I'm a financial nerd. I hate taxes. I hate paying them. I actually love taxes, but I love not paying them. So that's been my life for the past few years, and meeting this guy and hanging out with him for the past year or so has really helped me do that. So without further ado, I want to welcome you to the Seven Figure Flipping Podcast with my friend, Brett Swarts. All right, guys, I have a really exciting show. If you love taxes, you better stay here. I'm just kidding. The show today is going to be a lot of fun. We're going to talk about all the money that you make and how to keep it, I think. So my guest today is a friend of mine. We've been working together actually for the past few months, known each other for probably a year now, and I'm really excited to dive deeper into his business because I was on his show. We talked about some of the stuff that I do, but I didn't get the opportunity to listen to all the cool things that he does. So I'm excited about this today. I've got Brett Swarts on the call. What's up, Brett?
Bill Allen, grateful to be here, man. Thanks for having me.
I'm happy to have you. We got a lot of real estate investors that listen to this show. So what is a big tip? Like, I want to start right out of the gate. Like, what's something that you see that a lot of real estate investors do wrong that you could potentially help them do right?
Yeah, their mindset is just focused on cash flow, right? It's like cash flow is king, and it's like the one big thing. And it's like, gosh, that's just one part of it. It's important. Tax flow, cash flow, and debt flow is really what it's about. And really, how do you combine all three to be leveraged in your favor versus feeling like each of them can be sometimes exclusive or hurting one another or putting you in a compromised position when you're buying. And so what we're talking about here is exiting multi-million-dollar assets, Bitcoin, businesses, real estate. You want to make sure cash flow, tax flow, and debt flow are all in your favor.
Okay, what the heck are you talking about? So let's just assume that everybody listening knows what cash flow is. They probably have a sweatshirt or a t-shirt that says cash flow. They probably heard it a ton. Which one do you want to dive into first? I don't know what tax flow or debt flow is.
Yeah. So cash flow, right, is your NOI, and then you have your NOI minus, if you have debt on it, then you have debt service. And so basically, it's just like, what are you ending up with every month, every quarter, once a year? That's your cash flow. You put $1 million into something. What are you going to get on average per return, right? The tax flow is outside of the box. And if you're watching this on the YouTube channel, right, most people are raising capital, are looking at investments between year 0 and year 5, and what's my average cash on cash return? Well, tax flow is outside of the box. Now, it's also inside too, if you have some cost seg and some depreciation and all that kind of thing. But what we're focusing on here, want people to think about, is the capital gains tax that's happening before you show up to that new investment. Okay. And that's somewhere between 20 and 50% of your gain, right? Depending on what state you're in, depending on if it's California or New York or New Jersey, these are higher tax states, and how much depreciation you have. That's where we're talking about. So if you could know that you could offset and defer and build more wealth, you can compound. And so that's the first concept. And then the last one is debt flow. Like, we can't take debt for granted anymore, right? I mean, too many people thought interest rates would stay so low for so long. And now the people who are hurting right now are those that have debt that's reset, right? The interest teaser that was fixed has reset, and the debt has doubled, and it's sinking the ship, even though the deal was a nice deal, right? And it's now sinking. And so you've got to make sure you got all three of these aligned, especially for the hard driving entrepreneur or high net worth investor. And if you don't, you can get caught and get hurt. And this is what we really focus on, people having a mindset of all three of those.
Okay, that's interesting. So capital gains. So for those people who aren't like savvy on tax, you buy something, you hold it for a short period of time. It's more of like a passive vehicle. You get some short-term capital gains, and long-term capital gains greater than 1 year. So like your rental house, for those folks that are listening, or if you own an apartment building or something like that, or a primary residence, like you sell your house. Now there's some benefits of having a primary residence right now that you're exempt from some capital gains. But let's just say, like, maybe tell me what you do. Like, how do you help them if they are selling something that has some capital gains? And is that the only person that you could help if they have like capital gains?
Yeah, I mean, imagine you built this business, right, to millions of revenue, or like invested into Bitcoin at a really low price, or real estate, and you got a great value. And instead of getting, again, hit by capital gains tax, we build what's called a capital gains tax exit plan that allows this kind of I call it the tsunami of every deal, right? This tsunami is this big old wave that you can either keep riding this wave, right, or you can get crushed by it with capital gains tax, right? And by crushed, I mean it's 20 to 40%. I think that's crushed, right? You get to keep X amount after that. And so that's the idea. Like, how do you keep riding the wave of compounding interest, right? You've got all that momentum. You've built up all these blood, sweat, and tears. You poured into this thing, and it's going. And when you exit, the government wants to just, capture, their 20, 30, 40, 50%. Or you can defer it and keep riding the wave, right? And that's the idea, is you never really get off of the wave of momentum. You keep momentum and compounding interest in your favor by deferring this capital gains tax. And so what we specialize in is building these capital gains tax exit plans that allows people to keep more working for them for longer periods of time. It's that simple. And most of the time it's 20, 30, 40, 50% more on the exit, and that's the power of compound interest. And then you can move into like the freedoms we can do with it, which is a whole nother kind of topic here.
Okay, so is this just like a 1031?
So it's kind of like a 1031, except way more flexible. We call it 1031 Exchange Blockbuster. And why is it Blockbuster? Because you had to show up on a Friday night. You had to return it in 3 days. The DVD might be scratched. It might be checked out, and it's kind of nostalgic. You walk in there and it's kind of fun, but at the same time, you're like, I really want to get the movie that I want to get, right? I don't have to drive to the place or return the thing, right? Get the late fees. So 1031 is like Blockbuster because you have 45 days to identify, 180 days to close. You got to have like-kind replacement property. You also have to buy equal or greater value property, which means equal or greater debt. So if you have debt, you have to replace the same debt. And that's part of the debt flow challenge with the 1031 is if you're selling at a cap rate and you're going into a negative arbitrage situation and the debt is now higher than the cap rate, why would you sell? And or you're just in a tough spot, you just pay the tax. And so this is where you've got to make sure these three are balancing well. Second, the 1031 only works for investment real estate. It doesn't work for a primary home. It doesn't work for a business. It doesn't work for Bitcoin. So the Netflix version we call is called a deferred sales trust. It works for any asset of any kind. So Bitcoin, business, real estate. There's no timing restrictions. You don't have to put it into like-kind investment in a short period of time. It can go into passive real estate syndication with Bill. It can go into a passive film production with Bill, or business venture, right? Go into Bitcoin. You can exit Bitcoin and go into real estate, or exit real estate and go into Bitcoin. And so you're no longer, confined with like, I got to sell and buy in the same market, which is not great because that often means you're selling high and buying higher in the same market. In fact, it took 3 years in the 2008 crash. Most people forget this, for the real estate market to go from its low, from where it was at to this full low point, right? It's like a Titanic ship. Stocks and coin, a digital currency tend to go faster because of the liquid nature of it. In our scenario, it takes longer. And so our parents taught us to sell high, buy low. And that's what we do with the trust. We sell high and we buy low. Those are just a few of the concepts that I think are worth exploring today.
Yeah, so here's an example. I did a 1031. Me and a partner owned an apartment building in Alabama. So Southern Alabama, right by Pensacola. Me and him owned it for a few years. We sold it. This was in, it's probably like the end of 2022, probably 2022. We sold it. We put that money in a 1031. He wanted 1031. We had identified another place that we were going to buy in Texas. We both liked it. I was like, that's fine. I don't need the money back. It was a couple $100,000. And we identified it. And so sure enough, like we had the place, it ended up not closing. And so then what happened is, normally what I would do is I would sell the property, I would take it, I would roll it over into one of my other syndications, I would offset it with the bonus depreciation, and it'd be almost a 1-for-1 wash. But what happened was it ticked over into a new year. So we went from 2022 to 2023, the 1031 fell apart, and then I had to take the money. And so I had this tax burden that the timeline that you talked about screwed me. So Blockbuster screwed me over. And because that property didn't close, we didn't end up buying it. And we had a couple problems on title and we couldn't work it out. So we just walked away. And then I didn't have time or the desire to identify something else. So I had to take my cash and put it in my bank account. So it sounds like this DST you called a deferred sales trust would have been a better solution for us.
Yeah, I mean, as long as it's $1 million net proceeds, $1 million gain, this one, yours might have been a little bit on the smaller side. And we do recommend, the cost seg, kind of the lazy man 1031 when the deals are less than that. And we do those all the time, or if there's a little extra boot left over. And so I'll give you some real life deals that have closed recently. So we just did an $8 million business exit for an automotive dealership, automotive, maintenance shop out in Massachusetts, right? So high tax state, their tax liability was about $2.6 million of liability, right? They took about $6 million up front. They're familiar with real estate. They're an entrepreneur. They've invested in real estate. And so we built an entire plan where they didn't have to put all of that money into like one deal. Because that's the other part that's tough with the lazy man 1031 is sometimes you only have like one deal to put it into. And like, do you really want to put all, $6-8 million in the one deal? No, and that's illiquid that, is probably going to do well, but cash on cash might be 5% in the first year, like a deal we just did, and the 9% in year two. No, he wants to diversify, right? And that's the beauty of this. He has a chance to diversify. In fact, but he did put a substantial amount into a deal that we recently just did in Tennessee, right? That's a great deal. Yep. But it's a portion of it. And that's the key, which leads into the next part of this cash flow, debt flow, tax flow mindset is diversification. Like you've got to, one way to think about building wealth, and I think a way that de-risks is to have some diversification. And so we've gone into some lending, right, where we're making 10 to 16%. We've gone into the multifamily property with you, Bill, which is going to be great. We've gone into some stuff that's like 30-day liquid, right, in case something comes up. And so the mindset is, how do we practice optimal timing? How do we practice, when we can pounce on a deal? Like we're about to hit an election here in about 7 days, right? And so guess what happens in an election? A lot of things tend to happen, right? Well, if some powder's dry, you might pick up some opportunities. And so that's the idea here, that it's not just solving for the tax. It's really giving the purpose-driven investor, the purpose-driven entrepreneur leverage to do what they do best, which is what? Having their instincts buy deals when it makes sense, having them invest when it makes sense, and having the ability to have the powder dry to get out of debt. We didn't actually kind of finish that loop there. And the deferred sales trust, you don't have to take on any debt. In fact, you get debt free. We call it the Dave Ramsey debt free plan for your multi-million-dollar business or real estate sale, right? Part of where people got hurt in the 2008 crash, for commercial that is, not a lot of people did in 2008, is those who had too much debt, right? And so part of this is like go into smart debt when the marketplace has discounts, right? When you can get that positive arbitrage, you're buying on a basis like the deal that we just bought, $90,000 a door and $116,000 a door. Phenomenal, right? But don't buy when the deals are $250, $300 a door, right? When you're overpaying, but if you're in the 1031, you got to keep going in that route. And so that's the concept. Like, how do we give the entrepreneur, the investor, the ability to make decisions based upon the intrinsic value of the investments, not because the tax tail is pushing some kind of timeline?
Yeah, I love that. So for those that are listening, they might know somebody who's selling a business. They might be interested in selling a business. They might be selling some Bitcoin. They might have a big capital gain on a property that they sold or multiple properties that they're selling. They might be offloading multiple Airbnbs at one time or something as that market has changed. I have a lot of people that invest with me, so I raise a lot of money. So these are what a lot of my people are doing, and then coming into our multifamily buildings. So who is this for? You mentioned $1 million of gain. So who would this be for? Like if you have this kind of number, then they should work with you and set something like this up. Because you mentioned the poor man's 1031 that I've talked about on here before. So who is that?
First thing to understand is you got to have a big enough transaction that's eligible when it comes to the actual gain on the transaction. Okay, so you got to have $1 million net proceeds, $1 million gain. Okay, $1 million proceeds, $1 million gain, and that is really, really important to understand, because if you don't, then you're basically looking at an opportunity that the pain's not worth the trouble, right? The pain's not worth the trouble. So, but there's a one-pager, and I will give it to Bill, and perhaps he can put it in the show notes or something. Okay. So $1 million net proceeds, $1 million gain is important. Now, if you had two transactions, like 500 each that you can combine into one, we're okay with that, right? That's all right. We just don't want to be doing deals that are, hey, I got a 200,000, 300,000, 400, just kind of one-off deals. If you can combine two, that's good. Number one. Number two, we got to set it up before the close of escrow. Important. There's one exception to that I'll share with you in a second, but we've got to set it up and weave into the contract this trust that's going to receive the capital, which is how this works, prior to basically simultaneously when it closes and issues you a promissory note. The foundation of the structure is an installment sale, which is known as a seller carryback, okay? But basically you're selling your right to, let's say, $10 million that you would have paid $3 or $4 million of tax. And instead of taking all of that and paying that tax, you're selling your right before you receive it to a trust in exchange for the trust to pay you back slowly over time and slowly pay the tax. So that's kind of how this whole thing works. So we got to set up prior to the close of escrow. If you're under contract, we got to set up prior to the buyer removing contingencies. Okay, this is important. Now we work on a no cost, no obligation basis. So we'll walk through all of this to give you the options on this. Okay, here's the one exception. If you use what's called the best 1031 exit plan, which is our service, that gives you a regular 1031 option as well as the deferred sales trust as a backup plan. Okay. And you can go shopping. You can go look for your deal. You have all the freedom and flexibility and the leverage to make a great deal. If it doesn't work out, you could fall back into the deferred sales trust. So back to your deal, Bill, you would have been able to, had you used the best 1031 exit plan, go for your regular 1031, go shopping, go negotiate. Oh, it doesn't work out. No problem. Because it's like a parachute. You jump out and the DST catches you real softly on the ground, helps you to defer the tax. To do what? To turn around and buy a deal when it makes sense. And that's probably the best kept secret of this thing. Like, it's just not something where you have to feel like, oh, I'm an entrepreneur, Brett. I'm a real estate investor. I want to be running my own stuff. Absolutely, you can do that, right? You can partner with the trust to go buy your next deal, to develop your next deal, to start that next business venture, right? We had a client who exited 5 million of Bitcoin. She deferred about 1.85 million of tax. She bought Bitcoin at 50,000 and went to 50 million. And so this is when Bitcoin hit 54,000 a coin. And so she exited that, deferred the tax, and she used 4 of the 5 million to start a kind of like a Khan Academy. Like her passion was educating the youth, right? With like Khan does it, okay? KHAN, if you don't know about it, it's amazing, okay? It's totally free. Bill Gates is behind it. It's really cool. Okay, so that's what she's doing, something like that. Guess what happened to Bitcoin? It went to 54, then it went to 65, then it went to 68, and then it tanked to 15. But we had captured 5 million at 54, right? To go live out her passion and her calling, right? Now we're back over 70 by right now. It's like 71,000, I think, a coin today, which is pretty cool. So that's kind of the idea. Like, how do we multiply freedom and impact, right? How do we give people leverage on what's the biggest, sale perhaps in their entire life, maybe, and not have to suffer the consequences in the year's sale, all of that tax?
Okay, so set it up before close of escrow. You mentioned the best ever 1031. Is that what it's called? What did you call it?
The best 1031 exit plan, yeah.
Best 1031 exit plan. Does that mean that you guys can be an intermediary for 1031?
Yes, we have a strategic alliance that we've been doing this for years. That's one of the top in the country. So we outsource that, but we strategically align with them with specific language to have them add to their contract that we have our attorneys already approve. So it's already just templated for you. So you just go for your 1031. It's $1997, so it's just below $2,000. A typical 1031 is like $1,500, so it's a little bit more, but it gives you all of the leverage. So they'll do the 1031 service, but we have a specific language that we have in there by default that can save a failing 1031, and that's really the key.
Yeah, that sounds cool. I think a lot of people struggle to find a good 1031 a company, stuff like that. And this gives you like the best of both worlds. I would have certainly paid, we probably did pay, I don't know what we paid, but I would have paid an extra $500 to have that option, right? And honestly, my biggest problem was it happened like over the year. So like normally I would just be able to do something about it, but it blew up and I didn't even think about that, I was like, oh, okay, cool. And then I went on with my business and it didn't work out. And then next thing you know, January 15th, they're sending me money back. I was like, wait a second, I can't put this back in a deal. It's January 15th of the next year. Right. So that was frustrating. So now I'm all poor man's 1031, although when I sell the big stuff, I'm calling you. All right. What about, you mentioned the cost on something like that. Like how are these structured? Like, are they one-off? Like if somebody's like, oh, I'm selling a business, I want to talk to Brett. Is that, by interview? Is it fixed? Like, what does that look like?
Yeah, let's go through the cost. And the first thing is there's really two sets of fees. First fee is basically 1.5% of the gross sales price. So let's say you just keep it real simple. Let's say you're selling something for $1 million. It's about $15,000. One time, lifetime audit defense. That's the legal setup, like basically the CPA tax attorney firm that does all of that. So that's one of our business partners. Okay. Number two is the trustee. That's our role. We're the third party unrelated trustee, kind of like a third party qualified intermediary, right? So we're that group that executes the business plan of this trust. This is like a C corp trust. It's a good way to think about it. It's more like a C corp than like your, what you would think like a living trust. So it's not. It's ongoing. It has its own tax return, its own EIN, its own profit and loss, and it's in business to make a profit. It's in business to pay you back, right? So that's what keeps it all compliant within the IRS guidelines. So our role as the trustee, capital gains tax solutions, to help execute that, as well as help you, guide you, work with you and your team to make great investments on behalf of the trust. So those are the two things. So what we charge is about 1.5% to 2% on the net proceeds. So let's say about $1 million goes in. It's about $15,000 to $20,000, no matter how and where it's invested, whether it's in the stock market, whether it's in Bitcoin, whether it's in real estate, passive or active, or business ventures. It's about 1.5% to 2%. Our typical interest rates on the notes are somewhere between 7, 8, 9, sometimes 10% that we're returning net of the fees. And so, let's say you had $10 million, you would have paid $3 million of tax. We're going to put all $10 million in there, and we're going to earn, let's say, $900,000 of interest per year on average over any 10-year period, net of those recurring fees. So you have the one-time fee up front that's paid at closing. Then you have the recurring fees that's paid, and we typically cash flow our fees. So our goal is to not dip into the principal, and that's what most of our clients like too. They cash flow our fees, and then that cash flow also pays them. As they get paid, they pay the tax. They get a 1099. Really simple. We help them report it with their CPA on their tax returns, and that's kind of the model here. And then every 10 years, they can renew for 10 years and renew for 10 years, pass it to their kids. You can also have a shorter term. You can do a 5-year term or 3-year term. It doesn't have to be 10. But that's the general idea, is that, hey, if a tree falls in the forest and no one's around to hear it fall, does it make a sound? It's like, well, if your tax is deferred $3 or $4 million and every year you can keep deferring it, yeah, it's not tax elimination, it's tax deferral. I will give you guys a bonus here in a second about eliminating estate tax, which is pretty cool. That's for the ultra high net worth individual. But that's the answer to the question on the fees, Bill. And there's like a tax return fee of like $1,500 or so, and an accounting fee that's a part of it as well.
Okay, so let me see if I understand this. Let's say I sell a business, I'm going to get $3 million, right? Let's use 10 million. It's just an easy number to kind of break out. So I'm going to get $10 million from this business that I sold. And I go to you and I say, hey, Brett, I got this business. I'm about to sell it for 10 million. I'm going to have like $4 million in tax. This is going to be horrible. I sold my business for 10 million. I want to make 10 million, not 5.5 or 6 million. And so then, but I'm like, you know what, today I'd really like to take $1 million though, put it in my bank account and go spend it, go do something, buy a house. I don't know.
Yeah.
And so now I got $9 million that I want to say, all right, I'm willing to take basically turn it into an installment sale and say, I want to take $1 million now and $9 million I don't need right now. So then I go to you and you guys design a plan. And then do I understand this, that I have a $9 million note at some interest rate inside that trust that is kicking off cash flow to me for, let's say I sold it for 11 million. I took $1 million off the table. I have 10 million. Let's say it's kicking, you guys write a note at like 8%. So now put 10 million in there. I'm making $800,000 a year. And you take that 10 million and invest it into something. Is it your investment or is it my investment?
It's the trust investment, but you're the creditor and it owes you the money. So everything is spot on there, right? You would pay tax on whatever you receive personally, but the trust can go in and out of investments with you as a partner or by itself, all tax deferred. The only time there's really ever any tax, generally speaking, is when you take personal distribution. That's so key to understand that, right? Because people might be thinking, well, what if I just go into a business or real estate? Am I just paying the tax? No, not the way we structure it. If it goes to you first personally, it would be that. But if we set up an LLC and we do what's called a joint venture partnership, the trust can invest into that LLC with you, all tax deferred. You can build the business, build the real estate, invest into the deals, all tax deferred, and you get a new depreciation schedule. And this is where it really gets fun, right? Poor man 1031 is really good, right? And again, for the smaller amounts, it's perfect, right? Use it. It's less expensive. You already have a deal, perfect, right? But when you start getting these larger amounts, The painful part is you own multifamily property for over 27 and a half years. You fully depreciate the thing, right, on straight line. And then all of the cash flow is going to be taxed. And so even if I do a 1031, my old depreciation schedule travels, which is not good. That means I have a lower depreciation on my next purchase. So instead, we stop in the deferred sales trust. Even if you have a deal lined up, here's the reality of it. Even if you have a deal lined up, the reason is we want to reset the tax flow. Right? We want to reset the depreciation. So that 10 million that would have paid 4 million of tax, that has zero basis, that would have traveled and have a lower basis on the next one. I do an installment sale, get the 10 million. Immediately, I turn around and set up an LLC. Since it's a fresh LLC, it's a fresh depreciation schedule. I buy the same property I would have bought. I guess we could call this the rich man's 1031, right? And you put the money into LLC and you buy that same deal. You have a fresh depreciation schedule. Let's say you put 9 million down on a $25 million deal. You have a full fresh 25 million. Now, the way we structure it, you get about 80% of that. The trust would get 20% of that depreciation schedule, but that's better than having, the old one, right? That was tied to it. So that's kind of we're kind of getting into the ninja stuff here, right? And really what I want you guys to have a mindset on is not just what's the fees. I want you to see how to make the DST an investment and not an expense, right? When we ask better questions, we get better answers. We get better solutions. Our brain gets uniquely moving into a direction of abundance and a direction of a possibility, right? So how do we make the DST an investment and not an expense? Because someone might say, Brett, on 10 million bucks, 150 to 200K per year recurring every single year, isn't that expensive? No, not if we show you how to make it an investment, not an expense, right? Through these structuring, right? Structuring is so important versus just the fixed cost.
Yeah, I totally agree. It's, so I did something like this with my airplane. So I bought an airplane, I wrote off the whole airplane, but there's sales tax on an airplane. Mm-hmm. So, but the problem is, like, you can defer the sales tax by renting the plane back to yourself. Or renting it to a business. So like if you buy it in an entity, then that entity rents the plane, then you only pay the sales tax on the amount of income that you're renting the plane through. Mm-hmm. And so it's just a way to defer some of the sales tax that you're going to have to pay over time anyway, but you're paying on usage, not on lump sum of like $350,000. So I pay like, $850 a month right now, but I didn't have to pay $350,000 in tax right when I bought it. So very similar to what you're saying. And on top of that, although I don't have cash flow from the airplane right now where it's also making me money because it's in there. So I guess the thing that I'm still a little unsure of is I guess it can be structured. So the trust can be structured in lots of different ways from the sounds of it. It can be but like, I guess who owns, like, let's say we set up a trust. And then, so we do this deal. I did $10 million. It went in the trust. It's paying return 7 or 8% to me from the sounds of it every single year. But then when we make the investment into the apartment, how is the trust structured? Is it like, you're the trustee, I'm the trustee? How is that kind of set up?
What's the government behind this, and what are the controls, right? So the number 2 objection here is like, hey, like, I love this, all sounds really good, but what kind of controls would I have to give up, right? So our company is a third-party unrelated trustee, okay? These entities are set up, and Bill, you're married, right? So it'd be a trust that if you're the one using it, this new entity would only do business with you, right? So any single person or married couple has just that trust doing business with them. So funds are never commingled. You have 24/7 access to via funds online. Typically hit Charles Schwab is where we start. They can go back into your fund or different funds or different real estate deals, right? All the different stuff, businesses. So all of that's there. We can use third-party financial advisors for extra governance and extra advisors, that kind of thing. We have a third-party tax preparer that does the P&L and does a tax return. You get access to all that. We have lots of eyes and ears on this. There's like 5 really independent parties, really, if we really want to go through it. So that's important to understand. However, you don't own the trust. Because Bill, if you owned it, it'd be taxable. You just sold it to yourself, right? You just set up a trust and everyone just sells it to themselves. So by the way, if you ever do a 1031 exchange, you don't own the qualified intermediary either. So guess what? You give up controls for 45 to 180 days for a period of time in order to defer the tax, in order to go into your next deal. IRA companies, 401ks. So we're already doing this so many ways. We're just not doing it. Most people are not doing it with the deferred sales trust because they don't know how it works and they run out of time. So who owns the trust, right? Well, the trust is set up as a C corp. It doesn't have traditional beneficiaries like we would think of like a regular ownership. It has shareholders. So the shareholder is capital gains tax, which is my company. But here's the key: the trust owes you all the money. You're the sole creditor. So guess what? The trust owes you the 10 million plus the, let's call it, 8 or 9% every year, net of fees. So guess who has the first right to all of the money? You. Right? The collateral is secured against whatever you approve or disapprove. Okay. You got to approve it. So that's the key to understand that, like, legally, your protections is all the rights and protections of a lender. Another example is if a bank gives you a loan on a multifamily property, are they considered they're not the owner of the property? No, because they have a lien against it. If you don't pay, they're going to foreclose. Are they concerned that you're not going to get fire insurance? No, because inside of that, they say fire insurance. If you don't get this, we're going to take the asset back. So these protections in place, you have all the rights and protections of a lender. So that's DST 1.0. You own the promissory note. You put that inside of your living trust. Your children can step into your shoes. That's the asset you own, is the note receivable, okay? Number 2 is the DST 2.0. This has to do with estate tax. So the big problem with people who have a $1 billion company is they have what's called a death tax or estate tax problem. So usually they're trying to solve it by giving it all away to charity, which is nothing wrong with that if you want to give it all away. They try to have like 100 kids, they try to gift it away, but they run out of kids, they run out of time. Or they buy these huge life insurance policies, not to solve the problem, but to offset the tax-free upon death. Well, guess what? We eliminate all of those hassles. Charity's not a hassle, but the other two I feel like are kind of a hassle. And we eliminate by using what's called the DST 2.0 in one day in one sale. You have to sell it to somebody, like a third party. We can get that $1 billion exit outside of the taxable estate forever. No charity required, no life insurance, no gifting required. And that's remarkable because the stepped up basis does not solve for capital estate tax. It only solves for capital gains tax. Okay. So we've got back to the exemption amounts in case you know what those are. If you're worth 14 million married or 7 million single as of 2026, the government is the government's biggest mousetrap, wants to capture as much wealth as they can. And we want to stop that, right? Because we want to keep it working for you and families and building housing and doing all the really good things. So I'll pause there. I know that's a little bit more than you asked for, but I just want to give everyone that context of ownership. The last part about that is the DST 2.0, your kids can be the beneficiaries, okay? So your kids, upon your death and your spouse's death, they're the beneficiaries and they inherit estate tax-free and capital gains tax-free, okay? Why wouldn't you just always use the DST 2.0? It's a good question. 2 major reasons. It's not as flexible during your lifetime, okay? Not as flexible during your lifetime. And that's really actually the main reason, right? Most of our clients, they want to use the 1.0 at least for the first 10 million. And then anything above that, if estate planning, they're going to use 2.0. But that's a key here, that you want more flexibility with the payout structure, if that makes sense.
Yeah. So when should somebody set something like that up? Is it later on in life? Because I know a lot of people are starting to think about asset protection and things like that. So like I'm one of those. So building, trust structure, asset protection, and then looking at revocable and irrevocable trusts, setting those up, and then looking at, estate problems, going over $20 million net worth, like you said, $14 million net worth over that. It's okay. Am I willing to give up, almost 50% of this money to the government when you pass away? So should they be doing that like younger in life, like right now, or is that something to look at later? Or is there some like net worth trigger that should start that conversation with you? Yeah,
let's talk about 2 things: timing and asset protection. Okay, that's what you're getting at. Okay, I'm gonna kind of give you a benefit of the first one in case you're curious. Like, that sounds odd on that 1.0. Like, I don't own it. Oh, that's not. Well, yeah, it might be a little bit odd, but here's the benefit to that. If you don't own something, guess who can't sue you for it, right? They can't sue you for what you don't own. So it has built-in asset protection for 1.0 for sure, right? And that the only thing that they can get to potentially is the income that it's producing off of it that's paying you, if it's paying you, okay, in that given year which you're going through. You might turn off the payment. We might amend the promissory note, right? we might, and by the way, you can delay it for a few years too in the beginning to delay income tax, which is another kind of benefit here. So that's a built-in asset protection as well. The other one as well, the assets are in the trust, they're invested, and potentially off the payment, the same thing, they could get to that, right? But the kids are the beneficiaries, so I'd have to kind of get into the asset protection piece on that, but I'm pretty sure that's also the same thing. Now, timing. Well, timing is key, right? Timing is when you sell. Like if you already sold and the funds are already in your personal account, it's over, it's taxable, right? So when's the best time to set this up? Well, start planning now. We work on a conditional basis, so we don't charge anything unless you close, unless you want to do the deal. And if you don't want to do it or don't close, you don't owe us anything. So number one. Number two, we just got to make sure we have it before the close of escrow. And the last one for the estate planning one, I guess technically, like if you had a $150 million estate, the question is, how quickly could you sell it before you die, right? So you don't want to be like running around like, oh, I'm going to die next week and I got to try to sell this thing. So really, we look at it as a whole. We say, Bill, what is your big exit right now? And you say, Brett, I'm selling this $50 million business. Okay. How much of that $50 million is inside your taxable estate? You're like, all of it. Okay. Well, what's your plan for that? You're like, well, I got the kids, I'm gifting some of it too. Okay. I'm going to give it to charity. Okay, cool. And then, but you go, I can only get like 10 of it out of that. Okay. So what about the other 40 million? And you're like, I don't really have a plan. Well, let's do it right now. Like, it's not like you can just transfer it to the trust. You got to be selling it, right, to a third party buyer. So you have the buyer lined up for 50 million bucks and you're going to sell it, in a month. We got to do it now. If you don't do it now, then now that is going to be taxed at cap gains tax. It's still inside of your taxable estate. So I would say any major exit, you should be looking at this and then doing the pros and cons with what you have, if that makes sense.
Yeah, for sure. That does make sense because a lot of people might have heard that and been like, oh, I want to set up a trust for the things that I own right now, but I don't plan on ever selling them. And it definitely makes sense. So
let me add that one other thing real quick, Bill. You sell $1 billion deal and you use the DST Plus, it's the 2.0. Not only is that $1 billion outside your taxable estate, but all of the growth of your lifetime is also outside your taxable estate, right? So you live another 50, 60 years, that billion, let's just say every 5 to 10 years, you double that. Think about that for a second. That's all outside of your taxable estate. So if you're chasing life insurance, how much life insurance are you going to get for that, right? And again, charity's great. We love charity. Kids, you can't have that many kids. You know what I mean? Like, this is crazy. So we really believe that like that piece right there is so, so powerful, right? You can get it out in one day, one sale. It needs to be an exit. And all of the growth is forever outside of the taxable estate. Like, just incredible. Now, you do have to take payments back. So you're going to have a big payment coming to you, and if you're married, your spouse, based upon your life expectancy, and it's going to pour out, and you're going to pay taxes to receive those payments. Yeah, that's true. But here's the cool thing we would do. We would probably turn around and set up an LLC. The trust will fund that, and we're going to go buy thousands of apartment units, right? And we're going to produce a lot of cost seg bonus depreciation to offset a lot of that income that's coming in. And that's the idea here, right? Like leverage and with debt flow, leverage the DST for more investments for tax flow, also get the cash flow from the deals that you got and bring it all together with time on your side. That's the key, right? Like time on your side to be able to do all this. It's nothing's like it. This is why it's Netflix.
Yeah, it's okay. I'm glad we had this conversation because we've been working together. A lot of the people that are selling businesses are coming into some of our apartment buildings. And I'm like, okay, I think I understand how this is happening, but not 100%. Now I know. So $1 million proceeds, $1 million gain, like these are the people that should reach out to you. Is that right?
Yeah.
Like you're selling something.
Yeah, the bigger, the better, but the minimum is the bottom of that. Yeah. Mm-hmm.
Yeah. And then I realized we talked a lot. There was a lot of numbers. There was a lot of like big conversation here. I feel like big money. Just understand, like if you're getting started, like this is a podcast to come back and listen to when you're ready. Or that person that's like, oh, I'm selling a business, or that family member, like get them connected with Brett. So the thing that I see, I have people come to me all the time, like, oh, I'm selling my business, or I'm thinking about selling, I'm getting prepared to sell a business. I'm selling a bunch of Bitcoin. I have this huge, because people come to me a lot. When you're raising money, people come to me with tax problems. They come to me with, and most of the time what I get is, I have a huge 1031. Can I put in your apartment? And I say, I'm sorry, no, you can't. Because they can't. Like most of the people cannot put a 1031 into my apartment building. It just doesn't work. They got to be tenants in common. I have to do it from the beginning. The entire syndication has to be set up that way. Then when we go sell it, they're not. We all would have to put our money in the next deal. And this is nice. So we go sell something. I pull a big proceed out. I can go to Brett and say, "Hey, I just sold this. I got $3 million of tax liability from selling this. My portion of this apartment building. Can you help me?" And then he can tell me yes or no. So what's the okay? 2 questions. I'll ask the first one first, obviously. What should I have asked you that I didn't ask you?
Yeah, so there's we already talked about the kind of the controls. We talked about the fees. The other one that's really important is most people ask is like, what's this performance? What's this experience? What's the track record, right? So the track record is thousands and thousands and thousands of transactions, close to 30 years, okay? And close to 30 no change, no finding IRS audits. Really important to understand. Like, if you ever hear of a new tax deferral strategy, especially for capital gains tax, for your multi-million-dollar exit, make sure you're not being the guinea pig or the trial for, they've done it for a couple of years or they've done a couple of these and they haven't had any audits. That's not a good thing. You don't want to be the one that gets caught, doing something in the wrong way. There's also private letter rulings. We've never been on an IRS watch list or a dirty dozen list. We work with national law firms, CPAs, financial advisors. Like this, a couple quick deal stories, $17 million deal story, billboard business sale out of California. $13 million in San Diego, $8 million in Colorado. I told you about the $8 million in Massachusetts. We've also done Texas land flips, okay? Like multi-million-dollar flips, less than a year hold. This is important, right? We can also do short-term multi-million dollar exits, right? Where they tie the land up for 5 and they sell it for 9 and they double close it, right? But they don't actually hold title. They just hold the contract and they flip the contract, double close it to like the national home developer. So we've done that with those. It's also, this works for helicopters. Okay. So if you have the helicopter and you're fully depreciated, we can do it for those. Okay. Really important to understand that. That right there is like huge as you being a pilot, right? And just all the stuff about the cost, bonus depreciation for helicopters and or planes or all those different things. So legal part, right? Lifetime audit defense. Your CPA, your tax person, your real estate agent, they don't know about this most of the time, right? Your real estate agent typically doesn't want you to know about this because they want to keep you in the 1031 exchange, okay? That's how they get paid. And by the way, I'm saying this because I am a real estate broker by trade. This is what I grew up doing, building houses, selling real estate at Marcus and Millichap, all of those things. And so I understand the 1031 game in that if you have that buyer, you have a high probability of getting that check. And that seller also knows you have a high probability of them overpaying for the property. It's just the world that the 1031 puts you in. And so they don't want you to know about it. And so I learned about it the hard way through the 2008 crash after the market fell apart. And I go, there's got to be a better way from these clients who built this wealth up to have to lose all of it or have to dig out and squabble with the banks. Like, let's get out of the debt. So, and the last thing would be a lifetime audit defense. So if the IRS does come knocking, there's lifetime audit defense built in, perfect legal track record. So that's the legal aspect of this.
All right. You mentioned airplanes. So let's say I buy a $3 million airplane. I write the whole thing off. Bonus depreciation year 1, $3 million. I sell it 2 years later for $2.5 million. There's a $2.5 million recapture. So it's depreciation recapture.
Yeah.
You have taken people into one of these DSTs from that?
Yeah. So on the 2.0, so there's different types of depreciation. There's 1245 and 1250, right? There's accelerated, which is what you're doing on that. That's the main reason you buy a plane. And then there's straight line, right? Typically for just real estate, but you can do some bonus there too. So we, for the DST Plus in particular, okay, depending on your unique fact pattern, I would say bring us that deal. But I can tell you 99% what you just said, the answer is yes, okay? But I don't want to, out into the whole world right now where we're at without having your unique fact pattern, give you 100%. But with the DST 2.0, yes.
Okay, that's interesting. I didn't even think about that because obviously that was a very personal question for me with the real numbers. So, all right. So if the folks that are listening to this, they know somebody or they want to get in contact with you, what's the best way to do that? And throw that out there. And
BrettSwarts.com has all the socials, all the capital gains tax, which is the best 1031 exit plan. We have the Amazon best-selling book, Building a Capital Gains Tax Exit Plan. We have Kevin Harrington from Shark Tank in the book, which is pretty cool. I'd start with the book. That's really cool. You can get the free ebook too by going to my website, Capital Gains Tax Solutions. But all of that is found BrettSwarts.com, and Swarts is spelled Swarts. That Z is really tempting, but it's Swarts, and Brett with 2 T's.
Do you own Brett Swarts with a Z also?
Oh,
you should buy that and just redirect it to BrettSwarts.com. That's
a good call, Bill. That's a good call. And here's a little funny thing. My mom's maiden name, this is crazy, is with a Z. So it's Swartz. My dad is an S. So my whole life, people would say, spell it. I'm like, well, it's my mom's maiden name. So it's kind of wild, but that's a good point. I should probably get the Brett Swarts with the Z.com. I'm going to do it right now. So you're too late if you're going to try to do it and sell it to me.
That's right. That's hopefully a $1 million advice for you. All right. BrettSwarts.com. We'll put it in the show notes. You can just click on there wherever you're watching the podcast. I know we talked about a lot of big ideas, big concepts, but even if you're just getting started, hopefully what this does is it shows you different strategies of what to do when you're if you can control the tax game. Taxes are the second most expensive thing in your life. Taxes are the most expensive thing. The first most expensive thing is not knowing how to make $1 million. If you don't know how to make $1 million a year, then you should be joining our Runway or our Altitude program, because we can show you how to make money through real estate. And so then that's the most expensive thing, is not knowing how to do something. And Brett's kind of got both. He's got the tax solution and not knowing how to solve the tax problem. So both of these are big problems in your life. So making it is what we do. Keeping it is what Brett do. Actually, keeping it and making more from it is what Brett does. So,
because we got people like Bill Allen, right, who are buying and finding amazing deals, right, and it just compounds the whole effort. So it's a win-win. You got to be proactive. You got to plan. You got to get your skills sharpened. Otherwise, you're going to get hit and it's going to hurt.
Yeah, and that's why I've really loved working with Brett. Is I can drive some people over to him. He's got people that are already coming there, and then he can structure it properly, and then it can invest back in our projects and our properties, because that's what it is. It's got to produce a large amount of revenue to kick off those kind of returns to the trust. So it's been awesome working with you, man. I really appreciate you coming on the show. And everybody out there, you can go to BrettSwarts.com, Swarts. We'll put it in the show notes. And if you're interested in our Runway program or anything that we do here at 7-Figure Flipping, you go to 7figureflipping.com or 7figurerunway.com. Have a great one, and I'll see you on the next show. Bye.